Thank you, Rob. And thanks, everyone, for having me. As Rob said, my name's Chris Reid. I'm the Australian economist here at Morgan Stanley. But for this presentation, I'll be drawing pretty heavily of some of the work from our global economics and strategy team. So I've got a short, sharp 15-minute presentation here on the 12-month outlook for interest rates. It's good that it's short and sharp because it means it's closer to drinks, but also because it's a less than ideal time to talk about the short-term outlook for interest rates when you look at what's happened over the past week. So I just pulled out the market pricing over the past week. You can see if I was talking to you last Wednesday, I'd be telling you about a near 6% peak in the Fed rate, still staying around 5.5% by the end of the year. I don't have today on there, but we're looking very much down the bottom end of that chart now. Suffice to say, a lot is changing. For what it's worth, the view from the global Morgan Stanley research team and some of the people who know about the banking system more than I do is that they are less concerned about the systemic issues that may potentially arise here. What I think has changed in the past week and justifies at least some of this shift is a tightening in credit conditions, particularly in the US and Europe, even if we don't see further contagion beyond this. So things have changed. I'm not sure that the volatility that we've seen here is particularly representative of what to expect. But it just tells you how uncertain the environment is. So what am I going to do here? I'm going to fall back on telling you what our fundamental views are around inflation, around growth, and what we think that means for central banks, and then just link it into some longer term views around where we think the drivers of interest rates are. So what are central banks focused on at the moment? It's clearly still very much inflation front and center. There's good news and bad news here. Good news is globally, inflation, at least at the headline level, looks to have peaked. That's true for almost every DM economy. Australia is running a little bit behind schedule there, but we do expect us to catch up in the next quarterly print. The bad news is that at this stage, it's still driven very much by some of the more transitory and supply side factors. If you look at what's pushing global inflation down at the moment, it's goods prices around some of the supply chain easing, it's food and fuel. What's not coming down at this stage is services inflation. And really, if you look at the stickier, more fundamentally demand-driven components of CPI, it's services. And again, as a generalization across DM economies, that component is still not yet at a level that's consistent with central bank targets, right? And what that tells you is that broadly, we still need to see some demand slowing come through economies for central banks to be able to be confident that inflation is not just heading down now, but heading down on a path that's going to be consistent with their inflation target. So what this means, and you've seen this in some of the commentary from central banks recently, is there's a lot more focus on the labour market and real economic conditions in terms of assessing, how likely this inflation decline is to continue. And I'm using the US here as an example, but I think it does generalise pretty well to most other DM economies. And what we've seen over the past several months is conditions have held up really well. Yes, there's been a slowing in most economies, but by and large, that has been less than people have expected. We've been revising up our forecasts for the US. We've been revising up our forecast for Europe. Again, still in the context of a slowing economy, but things generally holding up better than has been expected. Now, I think it's worth emphasising here, the interest rate tightening is working, right? If you look at the interest rate sensitive parts of the economy, they are slowing, and in some places they are slowing very sharply. You can see that very clearly in the housing market, some aspects of investment, and some of the more durable aspects of consumption, right? What's holding up the growth outlook so far is some of the other factors. And two of the things that particularly in the US, our US team are flagging, firstly has been the job shortfall that we've seen. Throughout 2021 and the first half of 2022, economic activity far outpaced the recovery that we saw in the jobs market, right? So there was essentially a productivity boom. A lot of people were doing a lot more output versus what they were doing pre-COVID. Over the past 6 months or so, we've seen that really reverse, right? So economic growth has slowed, but the jobs market has been more resilient as a result of that. That gap now does look to be closing, particularly after some of the pretty strong labour market prints we've had out of the US in the last month or two. So we think that is probably a backwards looking factor, but it's certainly something that's held up conditions. The other aspect that's been sort of talked about quite extensively, and again is something that we see in most DM economies, is the build-up of excess savings. So clearly during COVID, you had consumption restricted, you had income in most cases actually boosted above normal levels through to overstimulus by governments and central banks. And that's led to a massive increase in build-up of savings. In the US and Australia, it represents about 20% of annual income. That's now being drawn down. So essentially what this is saying is that incomes have been slowing. As you've seen wage growth peak, as you've seen the labour market growth start to ease, but consumer spending has held up more because we've had that drawdown in those savings rates. Again, this is something that we think is coming to an end, particularly by the middle of the year. We expect that some of the more consumer-sensitive areas, particularly lower income in the US, will have tapped out most of those excess savings. There will still be a significant amount built up, but it will be mostly in the higher income cohort that it's less sensitive for. So because of this, we are still pretty confident in our view that growth will slow, interest rates will work, and we'll see an easing of conditions. And really, I'd say this is still what central banks need to see to be confident that they can get inflation down to target. And in particular, that tightening in credit conditions that I think we are going to see now as a result of some of these financial sector issues only exacerbate that. So what does that mean for central banks? As I said, very much disrupted at the moment, and I think we get the ECB decision overnight, which will set an important tone as to how systemic they view some of the issues we're seeing there. But certainly from a real economy perspective, even if you incorporate some of those tightening credit conditions, we think there's a little bit more to go, particularly in the US and Europe. We think by the middle of the year, most DM central banks will be at terminal rates. I think there'll be by that point, you will see clear slowing in the broader economy. You'll see some of that services inflation start to peak and come down. Again, the problem won't be solved, but you'll hear a lot more the sort of conversations we're hearing here in Australia, that it being appropriate to pause in restrictive territory and assess how conditions evolve. What I think will become an increasing debate over the next couple of months is just how long we sit in that wait and see environment. So I've got the Australian charts here because they're the ones I'm most familiar with, but it does generalize to the US. Typically, you don't stay, once you pause after you hike, you don't stay very long before you're moving to cuts again. That's what we've seen in the past. And, I think it's a reasonable baseline to expect this time, particularly given the speed of tightening and also, some of the financial stability issues we have been seeing. One thing that I would say is different this time is clearly the degree of the inflation issue. We have had a greater degree of inflation acceleration than we've seen throughout this entire period. And I think central banks in particular are very worried about what that means for inflation expectations, right? Not that inflation will stay at 7-8% forever, but that people, even as it comes down and it stays above target for longer, stop believing and anchoring at a 2% inflation rate, right? And that essentially, again, doesn't mean that rates are going to increase forever, but it certainly isn't an argument for potentially rates being held in restrictive territory for longer than we've seen in the past. So that is broadly our expectation. If you look at our forecast for most DM central banks, we've got rate cuts occurring around the middle of 2024 to the second half, which would, again, still be within the realm of what we've seen in the past, but certainly on the longer side. I think some of these shorter pivots would really require some more sort of financial sector contagion, which we are not expecting at this stage. So that's the near-term view. I do just want to finish off, though, by anchoring around some of the more secular trends we have seen in the past, right? Real yields have been in decline for a long time now, right? And if you look at the drivers behind these, or some of the positive drivers, they are really structural factors that we don't think have fundamentally changed, right? Demographics are a slow-moving shift that haven't fundamentally changed through COVID. Some of the excess savings issues that we've seen in terms of a global savings glut, again, does look to be persisting through this COVID period, even if you have a cyclical uplift in things like inflation and activity. And the level of breakout we've had from that, really 2-decade trend in real rates is something that we think, may persist in over, even potentially the next couple of years. But I think you will see some pretty powerful downward pressure applied on that as some of those structural factors take hold and some of the cyclical factors start to ease. And I'll just finish off by expanding that chart. There was a really nice paper from the Bank of England that extended this out somewhat longer, back to 1317, using some of the data that they had on, not just bond yields, because governments were a bit patchy in those days, but whatever the safest asset was at the time, which through a lot of that was land. And look, I mean, you can see a pretty powerful downward trajectory on those real yields, right? Again, there are cyclical shifts there, particularly in periods of disruption. You can see some of the wars there where you see significant volatility. But I do just think it's worth highlighting that even as we look at things on a 2 or 3 year view, it is important to keep in mind these structural factors. I think on a 5-year view, we will still be talking about demographics. We will still be talking about some of the wealth inequality and excess that has driven down real rates over the past couple of decades and even centuries. So that's my time. Thank you, everyone. I'll pass over back to Rob.